All right, let's talk about Kestra Medical's Q1 earnings. On the surface, the numbers look absolutely incredible. But the real story here is this constant tug of war between amazing, explosive growth and the huge cost of making that growth happen. So let's dig in. So you see a number like this, right? Revenue up 52%, and you think, wow, that's fantastic. But as investors, we have to look past that big, flashy number. It makes you ask three really important questions. First, what's actually driving it? Second, can it last? And third, what is all this growth costing them? And that last question, well, that's the whole story for Kestra right now.
Okay, so what's the big picture? What's the final verdict on Kestra's first quarter?
The market's verdict is pretty clear. Analysts are definitely leaning bullish. That incredible top-line growth is making everyone kind of squint and ignore the fact that the company's losses are getting bigger. But you see that key phrase at the end there, for now. It's like everyone's willing to give them a pass, but that won't last forever. This delicate balancing act is the story we're going to be watching all year long. So let's break down the numbers that have everyone so excited. Let's see exactly how they're beating the street.
And here it is, the big one. Revenue shot up 52% year over year to almost $19.5 million. In a market like this, a growth number like that just jumps off the page and grabs your attention. But, revenue alone can sometimes be a vanity metric. We need to look under the hood and see what's really powering the engine.
And this is what's under the hood. This is the engine room. Prescriptions for their main product, the Assured defibrillator, were up 51%. This is the number that really matters because it proves the revenue isn't just some accounting trick. No, this is driven by real, honest-to-goodness demand from doctors and their patients. Now, let's be clear. Kestra is still losing money. Nobody's debating that. But, and this is a really big but, they totally surprised Wall Street. The experts were expecting a loss of about 78 cents a share. Kestra came in with a loss of just 50 cents. Beating estimates by 28 cents, that's a huge deal. It signals that maybe, just maybe, management is finally getting a real handle on their costs. And you can see that revenue number right here. Look at the chart. Analysts were penciling in just under $18 million. Kestra didn't just squeak by. They blew past that number by a solid $1.5 million. This is the kind of decisive beat that earns management a ton of credibility and gives investors the confidence to stick with the story. So how'd they do it? Is this just a flash in the pan? Well, on their earnings call, management laid out their game plan very clearly. It's a pretty straightforward 4-part playbook.
So here's the playbook. First, more boots on the ground. They're hiring sales reps like crazy. Second, they're getting smarter about getting paid. All that revenue cycle management stuff just means making sure insurers pay them and pay them efficiently. Third, they're scaling up their device leasing model. And fourth, they are just piling on the clinical data to prove their device is the best one out there. And hey, you want proof the playbook is working? Just look at this, the payer mix. When they went public, only 70% of their patients were in-network. Now, they're pushing 80%. And you might be asking, so what? Well, in-network is basically code for higher, more predictable payments. That flows directly to a better top line and much healthier margins. It's a huge deal.
The CEO, Brian Webster, he really nailed the whole investment thesis with this quote. He's basically saying, look, our story is simple. They're not trying to create some brand new market out of thin air. They're just jumping into a huge existing one with what they believe is a way better product. It's a simple, confident message, and it really resonates with investors.
But, and you knew there was a but coming, right? This incredible growth cost money. A lot of money. And that creates the central dilemma for any investor looking at this company. It puts a ton of pressure on them to execute absolutely perfectly. And this slide really lays out that dilemma perfectly. It's the bull versus the bear case right here. On the left, you've got the good stuff. Amazing revenue growth, gross margins jumping by almost 13 percentage points. That's massive. And they even raised their guidance. But the bear case on the right is just as strong. Operating expenses are climbing fast, their losses are getting bigger, and they're burning through cash to fuel this fire. This brings us to probably the most important idea for Kestra's future, operating leverage. It sounds complicated, but it's simple. It just means, can you grow your sales faster than you grow your spending? Right now, their costs are growing right alongside their revenue. The magic moment, the inflection point everyone is waiting for, is when that revenue line starts to pull away from the cost line.
That's the path to profitability, and it's the #1 thing investors are watching.
So with all that as context, here's our official analyst take. What should you expect next quarter, and what's our rating on the stock?
All right, here's the Talk Ticker's outlook. We see revenue continuing to climb, probably landing somewhere between 20.5 and 21.5 million. But the stock itself? Expect a bumpy ride. It's going to be caught in that tug of war we've been talking about. And that leads us to our rating, market perform. Look, the good news about their growth is pretty much baked into the stock price at this point. From here on out, the focus shifts entirely to cost control.
So when that next earnings report comes out, here's your checklist. These are the 5 things you need to watch. First, is prescription growth still chugging along? Second, are they making progress toward that 70+% gross margin goal? Third, listen for what they say about their sales team's productivity. Fourth, any new insurance contracts? And fifth, and this is the most critical one, what's their quarterly cash burn? These 5 things will tell you whether the bulls or the bears are winning the argument. And as always, a reminder, this is not financial advice.